Hi, folks. This is Dr. Jeff Camarda with Phase 1 of A Word from Jeff, the investment paths forward, 2018 investment results, and where we think 2019 is headed. It's been a very interesting year so far. Just got a lot more interesting with the recent market plunge, and things maybe just getting started, as ugly as that may sound. After a wonderful 2017 and early 18, global markets have gotten pummeled in February, and that kind of has continued for a lot of markets throughout the year as a trade war bluster started to brew way back in February. Markets around the world plunged. Not so much in the U.S., or the U.S. markets have recovered. While the U.S. market has since recovered, largely we think because at the end of the day, the U.S. has the upper hand in world trade. Other markets are mostly just coming around. Japan, for instance, which we have a big piece of in our offshore and capital appreciation portfolios, recently hit highs not seen in decades. Now, as you know, many Camarda portfolios have very large allocations to non-U.S. investments, which have faltered for much of this year, largely due to trade uncertainty. We think this is temporary, and once trade is normalized, these markets will come roaring back and probably surpass the U.S. markets. The reason is non-U.S. markets are still very cheap, and the U.S. market is trading at rich valuations. Even after the recent plunge in early to mid-October, it's still quite richly or even overvalued by historical standards, which just may not be sustainable over the midterm. It's like having identical houses in two very similar neighborhoods with the same schools and everything. At a given instant of time, one house, the U.S. house, is selling for top dollar, let's say $800,000. The identical house, we'll call it the international house, is selling for only $550,000. Smart investors, who also have to be patient investors, would sell the U.S. house and buy the international house. On top of this, the U.S. dollar started to rise, largely because rising interest rates here attract capital from other countries. Since investors have to buy dollars to get them, this drives up demand and price for dollars and reduces the relative value of the other currencies non-U.S. stock markets are priced in. Until the dollar goes down, as it has a little bit lately, but really not much, investments in non-U.S. markets look worse than they actually are because of the dollar effect. On the other hand, the strong dollar makes these markets even more of a bargain in our view, and it's important to note that when the dollar trend eventually reverses, as it almost certainly must, this currency effect will give an added kick to U.S. investors' returns, so long as they stay invested long enough to see it. That's enough for now. You'll have another installment in a week or so. Thanks for watching. This is Dr. Jeff Camarda. Until next time, we'll see you.